discuss all that and much more, and especially what mutual fund investors to do. I have two market veterans. I hate to use the word veteran with you, Ashish, but yes, market veteran. And Raamdeo, thank you very much for joining us. What happened last week?
Yeah, so I think markets worldwide, they were ignoring this coronavirus threat. And the moment I think the Chinese PMI came, or Chinese, basically auto numbers came, that 92% decline, that really proved, because there was no understanding of the Chinese data. But when you said 92% decline in auto numbers, which is kind of reliable, that means the whole country is shut down. So there is no housing sales, there is no transport, there is no fashion, there is no eating out. I mean, like, China is shut down. It's a $15 trillion economy. Then the world started seeing the impact of it in the global economy, supply chain. And I think the more latest problem, which it is not so much about supply chain, that can be restored very quickly as the virus gets over or it subsides. I think the real issue is the psychological pressure on the consumer, how the consumer will behave worldwide. And consumers, they can be very finicky. Like in India, I believe chicken and poultry consumption is down by 50%. So how consumers will react all over the world? That would be a very difficult thing at this point of time. Though we know all these problems are temporary, the global economy will bounce back. But since the date is not there, there's no antidote still of the virus, which should be on the way sometime. I think we are going to be in some kind of flux.
So is the pain here to stay?
I would think so. I don't think... one thing that we were global equity boomers complete, in the sense that just before 1 week, we were all-time high all over the world, like almost 30,000 Dow. I mean, let's talk that way. I mean, it's all correlated. So from there only you have corrected by 10-15%. So I went and saw another shock in my memory in last 30 years was 9/11. Like, I was there in the 5 o'clock in the evening, and somebody, sir, there's something happening in US. So I went and saw in the TV, and the second plane came right in front of me. So that shock was quite total. At that time, US market fell by 16% in next 7-8 days or whatever. But that time, US economy was in very bad shape. Already it was declining. This time, US economy is in full employment, very solid. But still, that time if it fell by 16%, this time again it has fallen by 12-13%. I would think that one round fall is kind of that fear, picking of fear has happened. It's more about understanding where exactly the fear will go. So fear of the downturn is picked out, I would say. Now let's see how it goes from here.
Ashish, is very simple and perhaps the safest thing to come out and say, this is short term, let's think long term, don't cancel your SIPs. But let's take a messaging beyond that. The messaging beyond that is that if consumer slows down, if there is a bit of a change and churn in the world in terms of global growth, it will have impact on global markets, global economy, and in turn the Indian consumer, which had a terrible 2019.
Yeah.
We were not prepared for a terrible 2020, but looks like we've got all the makings of that.
Sure. I think that people see a lot of times, one has to think very closely whether the flow drives the market, and on the counter whether the market drives the flow. And we all appreciate that there is a bit of reflexivity to it. So right from September, October onwards, people were very circumspect. They were not believing that there is an upturn. But in January, people started believing that, okay, have we missed the bus, and is the tide really turned? So I think what has happened in the last 1 week might just make people kind of a little bit step back and then reassess how things will play out. And if this turns out to be like, okay, there is a V-shaped recovery, because ultimately it's a supply side shock. If it gets restored in the next few days, so that will kind of set the tone that how does the overall scenario shape up, and then people will react. But right now my sense is that people will definitely hold back a bit and reassess what was happening.
Raamdeo, with my 3-year-old niece, I am getting into the habit of teaching her ABCD. And I'm also playing the favorite, I'm also asking the favorite letters for everybody on the channel today, which is that what is your favorite letter for the recovery? Is it V, is it U, is it L, is it W? How do you think recovery will happen? What's your favorite letter?
I don't think it is going to be V-shaped. I'll be very surprised. I mean, because there is still no antidote of this problem. And which I mean, you should be asking actually your US investors or some commentator, what will be the ETF behavior? Because the world has gone ETF. I mean, in US, incrementally 100%, more than 100% is ETF. Now, ETF, one of the quality is that it's extremely liquid, and you can move in, move out, like in hundreds of billions of dollars very quickly. Now, if $4 to $5 trillion has moved in equity ETFs in last 5, 7, 10 years, this is the difference between last time and now. And say of the $4 trillion, if even 5%, which is not a very large number, 5% wants to in cash, you're talking about at least $200 billion of redemption. And that too overnight in a ziffy you want. So that behavior is going to, see the kind of money which has been pulled out by FIs, they're coming basically from ETFs. ETF redemptions are there, and those redemptions are being kind of encashed here. Good that we have net inflow and people are sitting on cash, so they are buying in. But globally, and we are very small part of the global ETFs, but otherwise in US itself, it is all about massive inflow and outflow of ETF. So I don't have any clue how they are thinking. So that can cause vertical decline which has happened, and they can also cause vertical upward shift, because having taken 200 billion out, if they want to again get in 200 billion in very quickly, then obviously recovery will be very fast. But I don't think that would be the behavior. Whenever it comes in every day 5. But when it goes out, they would definitely like to go out very quickly. So my sense is recovery will be much more staggered.
Okay. Now let's talk about the world, the view of the world. The view of the world is that US bond yields have plunged to 1.1%.
Is it?
The lowest ever, yes. 1.1%, 1.2% last, this Friday's data.
Yeah.
Crude has come down.
Yes.
Globally, interest rates are low.
Yeah.
So liquidity is not rare. Liquidity is abundant.
Abundant, huge. That's why the cut in the interest rate which they're talking about, what in fact it will have? It's about the demand destruction. It's not about fear of liquidity or credit. There is a credit issue with the consumers and all. It's all about just the fear of unknown. So you are looking at, you are trading into unknown and unknowable territory. Yeah. There is a complete fear of UU. So whether it spikes or is it actually global pandemic? Yeah. That fear. And all the conferences are closed. No conference anywhere. Forget about East. Southern Hemisphere. Even Northern Hemisphere, there is no conference happening. Now Olympic itself is in danger, whether it will be held or not, because it's in June. Then, like our Buffett seminar on 1st, 2nd of May, whether we should go, So once that tourism worldwide is very, very large. Corporate tourism, and that is not tourism actually, it's a corporate travel. Yeah. So tourism itself is killed, the leisure tourism completely killed. On top of it, the essential corporate travel is hurting. So I think the total damage to the global economy is yet not fully kind of
ascertained.
Like, see, I think I was surprised by the PMI was released on Friday of the China. The analysts there, the person who expected, they were expecting 46, from 53 to 46. It came out about 34. So even the guys on the ground, they are not able to gauge the extent of damage. US has already fallen below 50 in February. Now, how exactly they are shaping up. So I would say that it's some kind of a situation which is developing. The only good thing is that it could be a month or 2 or 3, Generally, this kind of things don't last very long. So, has the total correction which has happened is good enough.
Ashish, what was the first line of communication to your distributors? Are you saying that a year from now, when we will look back and talk about Jan and March 2019 in hindsight, will that turn out to be a buying opportunity, or it's a time when you should get out of the room because the house is on fire, and the faster you get out of the room, the chances of surviving are the highest?
So see, I was just checking today before I came here some data. While the last couple of years have been turbulent, the returns in India are not fabulous, but they are not disastrous. Well, actually, I noticed that for the first time we are seeing that last 1 year, 3 year, 5 year, 10 year, everything in India on the index is pretty much single digit. So it's not like we've been through some massive upturn. On the other hand, despite all the turbulence of 2018 and 19, if your 3-year return is still a reasonable single digit number, which is better at least than a deposit, then I think the outcomes are not that disastrous. So we are in a okay kind of situation. We are not looking fabulous. Like Raamdeo ji was saying, US is like at a cliff literally. So we are not looking fabulous, and we've not been looking that disastrous really. So our communication with intermediaries, in fact Raamdeo ji did a call over the last weekend, and our communication has been that we first need to kind of assess what is happening. So because the short-term fallout and say for example the long-term fallout on India and how things might play out, what is the impact on us? I mean, we need to figure out what is the impact directly on us, because there is an indirect impact which is very short-term, but directly eventually there may be some things to look forward to. So our communication has been that don't kind of like jump in, and at the same time it's not like we're sitting on some huge cliff of a return whereby we need to really pull out, because the returns have been middling, they have been directionless in the last couple of years. So our suggestion has been to kind of assess the situation and then see over the next 3 to 6 months, not to kind of do anything reactive right now.
Okay. Now, Raamdeo, because of coronavirus or because of where the economy is, you cannot make a case for a V-shaped recovery locally also. We are not going to go back to 6.5 or a 7% in a hurry.
Yeah.
Now, coronavirus will delay whatever projected earnings was. So what happens to the market in the interim? 15, 20, 25 stocks, that's it?
I think it will become more narrower, because some more companies will have tough times. So these are, say, like aviation. At least that portion was doing very well. Now you don't know what is the level of cancellations they have. So so newer segments of the businesses may become challenging. The inventory losses in the oil companies, So those kind of, like from $64 to $50,
yeah.
$15 in 1 quarter kind of inventory loss could be very large. So you are going to see, and even for the banks, some of the companies which were kind of coming back, they might again slow down. So the stress levels in the entire economy may go up. Now here, what kind of monetary response we have from the central bank or even some amount of counter-cyclical fiscal measure from government side, that is very important, because this country can actually use both of them. There are very few countries which can, like in Japan, you cut from 0 to minus 0.25 or something, it has very little meaning, So, but here there is meaning, because we are still at 5-6%, and fiscal. Our consumers have huge propensity to consume. Infrastructure can take a lot of expenditure in a meaningful way. So I think this is an opportunity, I would say, for the government to do counter-cyclical measure and really get the growth going, so that their own taxation issue, they have revenue issues all over, all the projects, government-funded projects, they're all in deep trouble because they don't have enough revenue. They're not able to meet their own day-to-day expenditure. And after that, nothing is left for the capital expenditure. So if by chance the economy further slows down from here, see, everybody is looking at from 4.5 to 6, 7. If by chance 4.5 goes to 3.5, then what happens? Because now that is not a low probability anymore. So to see that at least 4.5 is there or 5 is there, and this recovery is actually given a push, they should not despair. I think this ideological thought about 3.3%, 3.8% and all that, I think getting the growth is more important in the short run.
Okay. So I'm again going back to that very simple question.
Yeah.
Today, if you get out, you're getting out with a 10% cut from the peak, maybe a 12-13% cut in cases of individual schemes.
Yeah.
What is a prudent strategy right now? Get out? Because if things start unwinding on the risk front, on the leverage front, on the growth front, what is 10 today could become 30.
Yeah.
What is 20 today could become 40. Are we in that kind of a dire scenario, or if you've taken a 10% hit, you've managed to digest the fall, stay put now?
See, that's what I was trying to say. It's not. We are not in the US kind of scenario where we've made some dramatic, humongous. We are not at 2017 end where everybody's made much more than what they anticipated. If you see, we've been flatlining for quite some time. So from that perspective, how much we can have a cut, that is one. Second is, it would tantamount to being very, very reactive without understanding. See, like Raamdeo ji mentioned, this is an unknown, right? There are known unknowns and there are unknown unknowns. Unknown unknown is something which you actually don't know. So the point is that what will you achieve by reacting to it? So people need to be more focused on what their allocations are and what they are looking for in terms of time horizon. At least most people who I meet, I have seen that they underestimate their time horizon and they overestimate the need for liquidity. And these are the times when people tend to react and they make a bigger mistake. So I'm not saying that you should jump in right now, but after having seen this kind of a decline which is this sharp, especially amidst, now this is prone to some news coming, and like today morning, for example, Nifty was up 2.5% in a single day this morning, and then it's kind of eased off a little bit. So this is prone to being very, very volatile, and reacting may not help.
Okay.
Yeah, and actually, coming back to the same, what I have seen in my, say, 40 years, is that all the crises will come, and at the bottom of the crisis, person like me, who is permanently bullish, but I also get shaken.
Are you shaking right now?
Saturday, actually, I was feeling, when I saw the demand, there was one clip of a consumer psychologist from US. She said, people are focusing on the supply chain. They are not focusing on the psychology of the consumer, global consumer. So that could be a very unpredictable and volatile kind of a situation. So then I said, could there be even further problem? Because now the virus cases are happening more outside China than in China. So if the global consumption, particularly from developed market, $50-60 trillion of the GDP, if that gets seized for 2-3 months, I think we can have some disastrous moments. So, but what I have seen in the past, that this timing doesn't work. It just doesn't work. Like the way you didn't know at the top 10 days back that this decline is coming, same way we don't know at what pace and in what shape recovery is going to come. Don't focus on the market, focus on the portfolio. If you are a true investor. Speculator, of course, you have to take your stop loss or whatever. I mean, speculator is a different ball game. It's all about the price. That they have to move quickly, cutting losses or whatever. Otherwise, they won't be there tomorrow. But as an investor, this is a time to actually say that, boss, I don't care, and I'll stay put, and in fact, there's an entry opportunity in few companies where prices have gone a little haywire.
One question which I want to ask you is that you've always maintained that one should never waste a crisis.
Yeah.
If at all this is a crisis, where is this crisis creating opportunity?
Yeah, so let's see, unfortunately we don't have money, but definitely it is creating opportunities. Stocks are down 15, 70%, 20%, and still it is on. In the sense that we are not completely bottomed out, and that will not get even finer prices. I'm hoping, I have 1 or 2 stocks in mind which we are very keenly watching. So we will pile on. But what happens is, what you like generally doesn't fall at all. But this time I'm ready to sell something and build on that stock if I get a reasonable price. So it all depends on, that's how I'll use this particular opportunity. That I will not hesitate in selling not so attractive one and liquid one, and buy what I am hell-bent on buying.
Ashish, I'm sure your unit holders and your distributors are asking you tough questions on your exposure to auto. Didn't you figure out EVs coming? How come a long investing house like yours was not able to see this disruption? How are you defending that?
So frankly, we've been owners of auto for, I think, as far as I remember. At least I've been here 7.5 years, and I think it's been well before that.
He'll nudge your handle and say Hero Honda bought in 1985.
No, see, people who come in the last 3 to 5 years, for them the whole history may not be relevant. But I would just say 2 things. I think one is that a lot of times the price starts determining the narrative. So, when say Maruti is 10,000, then what people speak about, and when it is 5,500, what people speak about are 2 completely different extremes, right? And when the price is say 7,000, then there is no discussion which happens on it. So I'm not an alarmist in the sense that, okay, EV will come and this is all going to get wiped out. If you go actually by theory and the experience of the market evolution, the auto industry basically kicks off at $4,000 per capita. That's the past experience. See, there's a reason why FMCG kicks off at $1,000, white goods and electronics at $2,000, and auto picks up at say $4,000. There's a reason for it for a country of our size. So my sense is that a lot of it is ahead. Second is this BS4, BS6 is pretty big. It's for lack of anything, I can say you call it a man-made disaster in that sense, right? Because in a normal year there are 12 months, and this year you can say you had only 8.5 to 9 months, roughly speaking. So I think this narrative will change. Maybe it's a matter of 6 to 9 months. and then people who stay put. I mean, we are staying put, and I think when the price becomes good, we are actually adding to our positions. That's how I would put it.
Okay, Raamdeo, I'll just move from what's happened in the short term to really long term. When I say really long term, I've got a wealth creation study. We're really talking long term here. The most important thing is to understand the relevance of a business or relevance of an activity. For next 5 years, given the disruptive world we are in, one side you got Amazon, which is selling an experience, an expensive experience. Apple phones are the most expensive phones in the world. Other side you got Amazon, which is always selling cheap. They both are coexisting, right? Where do you think things would change, and which are the business you think will lose relevance and will gain relevance?
Yeah, so we are old types, we are not that techy, and that might work out positive as well as negative. So we'll negatively, because some of the newer businesses, we might be late in understanding. At the first sign of it, we may not be able to get onto it. But to make a reasonable amount of money in the market, I don't think you have to be that savvy. And fortunately in India, there is still a lot of opportunities in the so-called old businesses. So whether it is a banking, insurance, asset management, general insurance, or so that entire finance sector, thanks to public sector not taking their due share of the market. So they are almost 2/3 of the market. In insurance 50%, in banking almost 2/3. They are not taking incrementally, they are more like 20%, 25%. So that's where and those markets are also growing at about 15-17%. So what happens in that kind of situation? The winner takes it all. Winner companies in the private sector, they make huge amount of money. And that's why we are still giving birth to new banks. The real demand is that give more licenses to the banks. Other places the banks are completely kind of topped out. So that's the nature of opportunity here. And here we may give birth to a $100 billion bank, yet another $100 billion bank. There is one, but we may give birth to another 100 billion. And if some bank goes even from $20 billion or $30 billion to $100 billion, that's also a good bet for me. So that is one segment of entire financial services that definitely remains a 10-year kind of a very, very good compounded opportunity of more than 20% if you get the candidate right. Then you have the consumer side. And in consumer, you have a whole lot of variety, where some of them are completely timeless. What has been happening 25 years back will keep happening, like HULs and Nestle's of the world, staple and direct food stuff. But in consumer, you have a lot of varieties. You have you have all sorts of things, FMCG, this thing, then even the paints. And see, one other thing about India is that 60-62% of GDP is very predictable. That's a total consumer, and whole lot of consumer. Like even telecom is a consumer services. So you can see newer opportunities coming up, and 62% of GDP is very, very large. And so we are talking about now between finance and consumer. I don't know in GDP calculation where all this, I think financial services will come, but I think it will form part of consumer only. So almost 2/3 of the economy in India is very predictable, and that's where you have to find the businesses and the management and put your bets. It's very predictable. Now whether it grows at 5% and 7%, and whenever the growth is low, and particularly it's a synchronized global kind of situation where things are down, the central bankers all over the world, they are bigger than gods. What they will do, or what, I remember in 2003, post 9/11, we thought that this is the end of the world. Now we are dead types, We incurred losses for 1 or 2 months. From there, we got mother of all the Buddha, because it was such a huge global liquidity and cheap global liquidity that the whole global economy went into different kind of a thing, and China emerged as the biggest commodity consumer and producer and things like that. And Motilal Oswal itself went up by 100x in terms of size. So when you give up, when the world becomes pessimistic, that lays the foundation for a very big accelerated recovery. So I don't know what is there in store. You have to keep doing your investing in a very logical fashion.
So really appreciate your time. Thank you for joining us. Thanks. And hopefully when we meet next